April is Financial Literacy Month, but the math works the same in October. The most common financial advice right now is to budget better. Track your spending. Open a spreadsheet. Be more disciplined. That sounds right. It sounds like what a responsible person would do. And for about 11 days, it works. Then you forget to log a coffee. Then you skip a weekend. Then the spreadsheet sits there. Last updated March 2nd, judging you from a browser tab you stopped opening. The flaw is not your discipline. The flaw is the model. Willpower is a resource. It depletes. The Bureau of Economic Analysis reported the personal savings rate at 4% in February 2026. 4%. That means for every $100 of disposable income, 96 left the building. Not because people are careless, because the default setting for money in America is spend it. I am not a financial advisor. I do not know your situation. Nothing in this video is personal advice. This is how systems work. What you do with that is yours. And this is where most people stop thinking about the problem. The advice to automate your finances sounds simple. Set it and forget it. Move money automatically and watch the accounts grow. That is how it gets described in every blog post and every podcast. It sounds clean. It sounds safe. It sounds like a solved problem. It is not solved. Automation done wrong is not neutral. It is expensive. Here is what actually breaks. The first hidden risk is overdraft. You set up automatic transfers. 500 to savings on the 1st of the month, 300 to a brokerage account on the 15th. Your rent autopays on the 3rd. Your car insurance autopays on the 8th. Your phone bill autopays on the 12th. That is 5 withdrawals, 5 different dates. 5 chances for the balance to dip below zero between a paycheck landing and a transfer pulling. The average overdraft fee in 2025 was $26.61 according to Bankrate's annual survey. In 2025, that average ticked up slightly to $26.77. The FDIC puts the typical charge at up to $35 per occurrence at major banks. In 2023, the CFPB reported banks collected $5.83 billion in combined overdraft and NSF fees. That number dropped from nearly $12 billion in 2019, but it is still billions. By late 2025, Reuters reported overdraft fee revenue was climbing again at 14 of the 20 largest retail banks. The federal rule that would have capped overdraft fees at $5 for large banks was repealed in May 2025. So the system that is supposed to save you money can charge you $35 every time it misfires. Nobody talks about this part of automation. Everyone talks about the destination. Nobody maps the minefield between here and there. The fix is a buffer, a checking account balance that never drops below a floor. Some people use 500. Some use a full month of fixed expenses. The number depends on your cash flow, and you would need to calculate your own. But the principle is mechanical. The buffer sits, the automation runs above it. If the balance approaches the floor, the transfer pauses. Some banks allow low balance alerts at a custom threshold. Some do not. You would need to check. And this is where it gets personal. The second hidden risk is sequencing. Most people set up automation in the wrong order. They automate savings first, bills second, investing third. Or they automate everything on the same date, or they automate amounts that made sense 6 months ago and never revisit them. Sequencing matters because money moves on specific days and your income arrives on specific days. If your paycheck deposits on the 15th, but your rent autopays on the 1st, you have a 14-day gap where your checking account is running on whatever was left from last cycle. Automate a $500 savings transfer on the 2nd, and you just drained the runway. The architecture that some people use looks like this. Paycheck lands. Within 1 to 2 business days, a fixed percentage moves to a savings account, not a dollar amount, a percentage. Because when income changes, a percentage adjusts automatically. A dollar amount does not. Then fixed bills autopay in a window that starts 3 days after the transfer. Not the same day. 3 days later, that gap is the shock absorber. 1%. That is the difference between a high-yield savings account paying around 4% and a default savings account paying 0.01%. On $10,000, that is roughly $400 versus $1 per year. Same money, same effort, same level of attention, which is zero. The only difference is which account the automation points to. That is not a rounding error. That is a decision you made once and then forgot about. And every institution holding your deposits has a structural reason to hope you keep forgetting. They do not lose money when you automate. They lose money when you automate to the right place. Sage, 29, Indianapolis, works in supply chain logistics. Salary 61,000, credit score 710. Has a checking account at a national bank and a savings account at the same bank paying 0.01%. Pays rent, car payment, utilities, phone, and student loans manually. Every month, Sage logs into 5 different portals between the 28th and the 3rd. Spends about 40 minutes total. Misses one payment roughly every 4 months. Average late fee, $30. That is $90 a year in late fees. Plus the time, plus the mental load of remembering 5 dates, 5 logins, 5 confirmation screens. Sage also moves money to savings when it feels right. Some months, $300, some months, nothing. Over 3 years, the savings account grew to $4,200. At 0.01%, that earned about 42 cents in interest per year. Sage is not bad with money. Sage is running a manual system in an automated world. And the cost of that is not dramatic. It is just constant. A slow, quiet leak that never makes a sound but never stops dripping. By any reasonable standard, Sage is doing what most people do. The system just was not built to reward doing things manually anymore. Now, here is the part most automation advice skips entirely. The third risk is the most expensive one, and it has nothing to do with overdraft or sequencing. It is the automation you never set up at all. Bankrate's 2025 Emergency Savings Report found that 27% of adults in the United States have no emergency savings. 0. Among people earning under $50,000, only 11% grew their emergency savings in 2025. 8. In 10 Americans made no progress on emergency savings for the entire year. The reason is not laziness. It is not ignorance. It is that saving money requires an active decision every single pay period. And active decisions lose to inertia almost every time. Behavioral economists have known this for decades. The 401k auto-enrollment research proved it. When companies switched the default from opt-in to opt-out, participation jumped from roughly 40% to over 90%. Same people, same plan, same money. The only thing that changed was which option required effort. Your checking account does not auto-enroll you into saving. Your bank does not auto-enroll you into a high-yield account. Your brokerage does not auto-enroll you into a monthly contribution. Every single one of those requires you to go build it yourself, and every month you do not, the gap compounds. Person sets up a $200 automatic monthly transfer to an account averaging 6% annual return. Starts at 29, runs it for 30 years to age 59. That is $72,000 contributed. The account balance at the end, according to standard compound interest math, approximately $201,000. Person B means to do the same thing but keep saying next month. Starts 5 years later at 34. Same $200 a month, same 6%, 25 years, $60,000 contributed. Account balance approximately $139,000. The gap is $62,000. Not because person B saved less per month, because person B waited 5 years to press one button. $62,000 for a 5-year delay on a 2-minute setup. It feels like realizing your car has been running on 3 cylinders for years, not broken enough to stop, just broken enough to cost you on every single mile. Here is what the architecture looks like when all 3 risks are addressed. First, open a separate checking account or sub-account as a buffer. Fund it with 1 month of fixed expenses. Do not touch it. This is not savings. This is infrastructure. Second, Set up automatic transfer from primary checking to high-yield savings, percentage-based, not dollar-based. Some people use 10% of take-home pay. Some use 20. The number is yours. The trigger is payday plus 1 business day. Third, set up automatic bill pay for every recurring fixed bill, rent or mortgage, car, insurance, phone, subscriptions. Due dates clustered in a window 3 to 5 days after the savings transfer. Some billers let you choose your due date. Some do not. For the ones that do not, you can call and request a date change. Most will do it. Fourth, set up automatic investment contribution. This goes last after buffer, after savings, after bills. Whatever is left in the system after the first 3 layers is your discretionary spending. You do not budget it, you do not track it. It is what it is. The important money already left before you could touch it. Fifth, set a calendar reminder once every 90 days, 15 minutes. Check the buffer, check the transfer amounts, check for failed payments. Adjust if income changed, that is 4 times a year, 1 hour total. That is the entire annual maintenance cost of a system that runs 24 hours a day, 365 days a year. The whole thing takes about 90 minutes to build. One Saturday morning. 1 cup of coffee, a phone and a laptop, and then it runs. No spreadsheet, no willpower. No logging in on the 28th to manually move money while you are also trying to remember if you paid the electric bill. The system was not designed to set this up for you. No bank sends you a notification that says your default savings account is earning you $1 a year, and there is a better option 3 clicks away. No biller calls you to say, you have been late twice this year and it cost you $60. Would you like to turn on Autopay? No brokerage sends you a reminder that says, you told yourself you would start investing 6 months ago and you still have not. The architecture exists, the tools exist, the accounts exist, the buttons exist. Nobody presses them for you. 3 things you can look into tonight. 1. Check what your current savings account is actually paying you. The number is in your account settings. 2. Look at your last 3 months of bank statements for late fees or overdraft charges. Add them up. That is the cost of your current system. 3. Find out if your bank or credit union offers automatic transfer scheduling. Most do. It is usually under transfers or recurring payments. Even if you already filed your taxes, even if April is almost over, even if you are watching this in November, the math does not care about the calendar. The system was not designed to remind you. Now you know. You are not bad with money. You are just running someone else's default settings.